Sometimes the market does something that makes everybody stop and say, hold up, what just happened here? And today, that stock was Opendoor. The headlines came in, shorts jumped on it, people started panicking, and now the question on everyone's mind is this: is this really a reason to worry, or is Wall Street just playing one of its old tricks again? Stay with me, because we're going to break everything down in plain English so you understand exactly what's going on, and by the end of this video, you'll know whether this is just noise or an actual red flag. Quick note before we dive in: this is not financial advice. It's just my opinion for educational purposes only. Always do your own research before investing. So let's talk about where we stand. Opendoor closed down around 1.5% today, bouncing between a low of $9.91 and a high of about $10.49. And here's the kicker: the volume was weak. Only about 195 million shares traded compared to an average closer to 375 million. Low volume moves like this usually tell you one thing: this isn't broad panic. It's more like targeted pressure. Now, what really triggered this? It comes down to two things: a press release that hit after hours yesterday and a Form 4 filing. And the filing, it basically went over the CEO's compensation package. Now, here's the thing: if you've been following Opendoor, this wasn't new information. The numbers have been public for a while, but the market acted like it was brand new breaking news. The filing showed stock awards totaling about 83.3 million shares. They're spread out in tranches with different performance targets, ranging anywhere from $9 a share all the way up to $33. Again, all of this was already known. But here's where the game begins. Shorts took that headline, amplified it, and used it as fuel to push the stock lower. And they were busy. Shorts returned around 4.25 million shares today. In total, about 24% of the free float, that's roughly 158 million shares, is currently sold short. That's heavy, and it tells you exactly why we saw the move we did today. This is classic. Retail traders see CEO awarded 83 million shares and instantly think, oh no, dilution, time to sell before it crashes. But let's step back for a second. Opendoor's outstanding share count is about 735 million. So even if you assume every single awarded share eventually vests, the impact isn't nearly as scary as Twitter or Reddit threads make it sound. But fear spreads faster than facts. Bigger players know that, and when retail starts to panic sell, shorts step in, push it lower, and make their money. It's a domino effect. Here's where I stand. From a macro point of view, this dip looks totally unjustified. Remember, the Fed just cut rates by 25 basis points, and Powell basically signaled more cuts, possibly another 50 basis points in the next two meetings. That's a tailwind for housing and real estate-related names like Opendoor. If you're looking long-term, this looks like opportunity, not disaster. Let's check the options market, because that usually gives us clues about sentiment. Right now, there's about $58 million in calls versus $9 million in puts. But here's the twist. Almost half of today's options flow leaned bearish. Bulls are placing bets for Opendoor to trade between $10 and $12, while bears are gunning for it to fall under $9. Tomorrow's expiration is going to be key because there's heavy open interest stacked at the $9, $9.50, and $10 levels. Those strikes could trigger some serious volatility. One thing that really stood out to me: market makers recently expanded option chains all the way up to $21. They don't just do that for fun. That suggests they see real potential for this stock to run higher in the future. Maybe not today, maybe not tomorrow, but the fact they even opened that range up tells you where they think possible upside could be. Now, on the chart side, Opendoor is still holding above its 10-day moving average. That's a good sign. Right now, support is sitting around 9.94 cents, and the next resistance levels are $10.75 and then $11.20. If momentum picks up, those are the levels to watch. If it drops, $9.14 becomes the next strong support. Dark pool activity? Pretty quiet, only about 1.6 million shares. That lines up with today's low volume. Institutions aren't making huge moves in the shadows, which again tells me this wasn't some massive fundamental-driven sell-off. So where does that leave us? If you're in Opendoor for the long term, if you actually believe in their business model, their role in reshaping real estate, and the broader housing trends, this dip is noise. Shorts are just exploiting weak hands. But if you're only here for quick momentum plays, you might want to be careful, because without big money stepping in today, it could chop sideways before making a decisive move. For me, the logic is simple. This kind of pullback based on recycled bad news doesn't hold weight, and the math backs it up. If that supposed 83.3 million share dilution was really being priced in with 735 million shares outstanding, Opendoor should technically be down closer to 9%. But it's not. That right there tells you investors aren't buying into the panic story as much as shorts would like them to. So, I'm curious, do you think this is a golden buying opportunity, or do you think shorts are right this time around? Drop your thoughts below. I'd love to hear what you're seeing. And as always, if you found this breakdown useful, do me a quick favor. Hit that thumbs up, subscribe to the channel, and turn on notifications so you don't miss the next update. Because trust me, with a stock like Opendoor, this isn't the last time we're going to see drama like this play out. Disclaimer: this video is for informational and educational purposes only. It should not be considered financial advice. I am not a licensed financial advisor, and I do not make any guarantees about future performance. Always do your own research before making any investment decisions, and consult with a qualified financial professional if you have questions about your specific situation.